Hey guys, welcome to DevTech Finance, and in this video we would be talking about the turnover ratios. As I was continuing my sessions on ratio analysis, I already talked about the liquidity ratios and profitability ratios. So all you viewers who are new to my channel, I request you all to subscribe to my channel and do watch those videos to get a better understanding on this topic. Let's get started, and we would start with the introduction part. So turnover ratios measures the company's efficiency in employing its asset to generate revenue. So when we are talking about turnover ratios, these ratios measures the company's efficiency, how efficiently the business is employing its asset so that it can generate sales out of it, so that it can make more production. And if there would be more production, more sales, there would be more revenue, and thus it would create a profitable business. So this is how turnover ratios seems to be so important, because it indicates the efficiency of business in how it's employing its asset. See, the last point is that it is also termed as efficiency ratio because it shows the company's efficiency in conversion of assets into sales, which in turn reflects the ROI. Why is the term ROI being used here, which is the return on investment? Because if a business is having so many assets, there is a lot of amount employed in buying of those assets or acquiring those assets. And now if those amounts are employed in form of investment, certainly business or company needs return out of it. So those returns would be indicated by revenues, how well it is generating revenue, and this is what our turnover ratios are indicating. So thus it is also giving us an idea about the return on investment. The larger the turnover ratio, the better, as it shows the company is optimally utilizing its asset as resource to earn revenue. So the larger would be the ratio, it would give us a better picture about the company, because it would show how the company is able to utilize its asset, and thus it is creating more revenue. So how we would get a larger ratio? Only when the sales would be larger, only when the revenues would be more, and thus the larger turnover ratio would indicate a better position of the company. And see, turnover ratios are usually calculated by dividing the revenues from average asset balance. Okay, so this would be the basic formula for all other turnover ratios, because this is the main theme. It is calculated by dividing the revenue which is generated from sales or the core business operational activity, and dividing it by the average asset balance, and thus we arrived at the turnover ratio. So let's have a look that in this video we would be talking about these 5 types of turnover ratios. First one is inventory turnover ratio, second is debtors turnover ratio, third is fixed assets turnover ratio, fourth is total assets turnover ratio, and fifth is working capital turnover ratio. I must make you remember that ratios are very important quantitative financial analysis tool which gives you an idea about efficiency of the business performance and how the business is going about, and thus it is the most important and widely used tool. So getting an idea about the ratios, you must be aware about the financial analysis, how it is done about any companies. Okay, so let's talk about inventory turnover ratio. It measures how efficiently the stocks are being converted into finished goods to generate sales. So obviously we are talking about inventory, which is also referred as stocks. So how efficiently the business is generating sales by converting its stocks into finished products and then earning revenue through it. So this is what is indicated by inventory turnover ratio. Just have a look at the formula, that it is calculated as cost of goods sold divided by average inventory. So you can get an idea that in denominator we are taking the average asset balance, which is average inventory, and in numerator we are taking the cost of goods sold. And you can also have an idea that the numerator is the data would be extracted from P&L statement, while in denominator this is extracted from the balance sheet. And because these two are from different financial statements and both the financial statements are very important, thus to make a compatibility in denominator we take the average balance. because P&L statement is for the whole accounting period, while the balance sheet is at a specific point of time. To balance, to make both of them compatible, we take the asset from the balance sheet as an average. So this would be used in every turnover ratio. Just keep it in mind why we are using the average balance. Now have a look at the example. If the COGS is given as 80,000, opening inventory we are having as 10,000 and closing inventory as 15,000, you just need to calculate the average inventory balance and you can simply arrive at the inventory turnover ratio. So average inventory would be opening balance plus closing balance divided by 2. Here we are having 10,000 plus 15,000 divided by 2 and we got the balance of 12,500. Now just put the values in the formula and you would get the inventory turnover ratio. So we were having COGS as 80,000 and average inventory as 12,500 and thus we got the ITR at 6.5. Now you may ask the question, what is this 6.4 indicating? So I must make you remember that in my previous videos on ratio analysis, I already told that ratio in itself doesn't indicate you anything. It would be useful when you compare it either with the previous year figures or you compare with any other company's figure. So for say we are talking about company XYZ in which in previous year was having 5 as inventory turnover ratio and today in this year it is having 6.4 as inventory turnover ratio. So obviously it has done better because the inventory turnover ratio is high, which means it has efficiently utilized its stock in converting that into sales. Let's have a look at the debtors turnover ratios. It signifies the efficiency of business in converting its debtors or credit sales into cash. Just have a look at the formula. It is derived as net credit sales or revenue dividing by average trade receivables. So many businesses and today almost all the businesses deals in credit sales because it becomes so important to gather all the opportunities to create market presence and to gather most to capture most of the customers. Credit sales becomes important, and when the businesses make credit sales, it generates its current assets as debtors or account receivables which it has to recover in form of cash in shorter period of time. So debtors turnover ratio indicates us how the business would be, how efficient the business is in converting its current assets, which is the debtors or account receivables, into cash. Let's have a look at the example. If the net credit sales is given 10,000, opening balance of trade receivable is 1,000 and closing balance is 500, just put the values in the formula of DTR and you would arrive at the debtors turnover ratio figure. So net credit sales we have taken as 10,000 and average trade receivable is opening plus closing divided by 2 and thus we had a figure 13.33. Higher the ratio, the better would be the company in managing its credit sales. And we are talking this in respect of the sales being generated by converting it into the by converting the trade receivables into an efficient way in an efficient utilization in an efficient manner. Let's have a look at the fixed assets turnover ratio. So fixed assets turnover ratio measures how efficiently a company uses its fixed assets to generate revenue. Now, similarly, as we talked about the inventory, we talked about the debtors, and we are having a look at all the assets category. Now comes the fixed assets. So how the business is being able to utilize its fixed assets. For say example, there is machines, there are many other machineries which are being used. So how those machineries are being used and how it is resulting in the production quantity. So if the machine is being used for this much amount of time, what is the effect on the production and how the production which is made is able to generate sales. So the whole cycle, how fixed assets is being used in generating revenue, how it is efficiently being used. Thus, fixed assets turnover ratio gives us an idea about company's efficiency in utilizing its fixed assets. And as you know, fixed assets involves huge capital invested in it, which makes it very crucial to optimally utilize those assets. Because if those assets are not being utilized optimally, it would for sure result in a lower level of production, and lower level of production would meant lower sales and thus a lower profit for the company. So you can see that fixed asset turnover ratio is calculated as revenue from sales divided by average fixed assets ratio. So the formulas you can observe is very similar, just to whatever turnover ratio you are considering, you just have to take that in denominator the average balance, and in numerator always there is revenue from sales, which is the core operational activity of the business. So again, take an example. Revenue is given as 1 lakh, opening balance of fixed asset we are having 50,000 and closing balance as 45,000. We would just put the values in the formula to arrive at the figure that is 2.10, and this is our fixed assets turnover ratio. Let's have a look at the total asset turnover ratio. So total asset turnover ratio is quite similar to fixed asset turnover ratio. The only difference is that here we are considering current assets as well. So here we are considering the total assets, fixed as well as current. So how total assets of the company is able to generate sales or revenue for the business. This is indicated by this formula. So just have a look at the formula of total asset turnover ratio, which is equal to revenue from sales divided by average total assets. And you can see the example says revenue equals 1 lakh, opening balance is 60,000 and closing balance is 50,000. So we came to this figure of 1.81 by putting all the values in the formula. Let's have a look at our last ratio, which is working capital turnover ratio. Working capital ratio measures the company's efficiency in using its working capital to generate revenue for the business. So here we are talking about working capital, and you know working capital is what shows the liquidity of your company. So if you are having liquidatable assets in your company, how you are using those to generate revenue and whether it is helping the business in generating revenue for it. This is what is indicated by working capital turnover ratio. It also indicates the relation between liquidity and profitability of the business, because working capital represents the liquidity of business and revenue represents the profitability of the business. Thus, a kind of relation is being tried to establish between liquidity and profitability. And just have a look at the formula, which is very similar. Just you have to take the average working capital in denominator, and in numerator again you would be considering revenue from sales to calculate. And have an example. Revenue from sales is given 1 lakh, opening balance of working capital is 50,000, closing balance is 40,000. Now you want to calculate working capital turnover ratio. Just put down all the values and we would arrive at 2.22. This is what working capital turnover ratio is. So these data are just assumptions, just an assumed data being taken just to show you how the calculation is being done. And these figures you can extract from the financial statement of any of the company of your choice, just to take out the ratios and get an idea about how the company is efficiently managing its asset and generating sales and revenues for it. So in my upcoming video, I thought I would be explaining how you can just check out the financial statements of various companies of your choice and how to read those financial statements and how you can figure out how the business is going about, how efficiently the company is maintaining its assets, its liabilities, its revenues, its expenses, all those things. So in my upcoming video, I would be talking about how the financial statements could be read of any of the company. I hope you like this video. Thank you for watching. Do like and share my videos, and don't forget to subscribe to my channel DevTech Finance. Thank you all.